Hi guys, and welcome back to Quarantine Investors. I hope everyone's having a great weekend. We just went through a pretty crazy week in the markets. So I wanted to just, cover a few things that were on my mind about the markets and where we stand and how to prepare for what's upcoming. Last year we had, a lot of confidence in this V-shaped recovery that's sort of fading now. And I don't believe that's what we experienced at all. A lot of people are basing the V-shaped recovery off big indexes like the S&P 500, which are pretty tech weighted. You have Apple, Microsoft, Amazon, Facebook, Google, Tesla, and they make up over 20% of the S&P market cap. So pre-COVID levels, we're still up, 30% on the S&P, 8% on the Dow, 25% on the NASDAQ, and that's concerning for people. But is the economy 10 to 30% better than before COVID? Obviously not. But there's a disconnect between the stock market and the economy that's existed back as far as I know. They do have influence over each other, but they don't directly correlate. Some of these tech stocks are worth these valuations, and a lot of them are cost effective and generate massive revenues more now than before COVID. So where they're at, isn't ridiculous as it seems, but it is still, the market is still kind of, sus. A lot of money is shifted out from value stocks and into growth and spec stocks. So there's a fair amount of room to fall for some of these overvaluated stocks that, have no reason to be where they're at, besides that investors didn't really know where else to put their money in 2020 besides tech and real estate. And then you got stocks, that I owned and traded for years, and they haven't even begun to recover. REITs, real estate investment trusts, service, retail sectors, they're all still in pretty rough shape. And then on top of that, like, people are forgetting about zombie companies. They sort of fell off the radar, but there's over 200 companies that still exist. Like Boeing, for instance, got over 30 billion in bailouts last year. And there's lots of studies showing the damage zombie companies can do on the economy. Bloomberg reported bailout debt around 2 trillion. That's a debate for concern. Some of that stimulus money that was allocated to these inactive and bankrupt companies, some of them might bounce back, some of them might not. It depends where the economy's headed. The bottom line is a lot of the sectors haven't recovered and might not recover for a long time or ever. Now we're just starting to see value stocks start to recover more as the stock market drops in other areas. Another thing that we've heard a lot of is inflation versus deflation. Some are saying we have inflation, some are saying we have deflation. I think we're experiencing both, and it's temporarily keeping things at bay. On the deflationary side of things, technology indirectly causes unemployment, creates efficiency in production, costs decrease, supply increase, shorten supply chain, resource requirements generally decrease. Except for the semiconductor chip shortage right now, that's kind of big headwinds for tech. COVID was deflationary, caused lockdowns, unemployment, businesses shut down, demand decreased, cash flow decreased. And then on the inflation side of things, stimulus money, more money being pumped in the economy makes the money worth less, drives other products and prices up. Some went towards zombie companies. That doesn't really affect inflation. The economy reopening is inflationary. We're going to have more spending. People are going to want to go back to normal. Demand increases, cash flow increases, purchasing power is going to go down. Obviously, there's other factors contributing to inflation and deflation, but I think it's currently I don't think it's currently affecting the stocks in the market as much as adding fear and panic to the markets right now. Those initial signs of inflation and treasury interest rates rising is playing a huge role in the last couple of weeks. And I'm going to explain that further in my next video on the Fed's relationship with the stock market. So back to the stocks, like, stocks have been acting pretty irrational since the crash last year. I've noticed massive beats in earnings and then the stock will drop heavily after the earnings report. And it's happening more in overvalued companies priced to perfection, where the good news is already factored in. And the stock market's already, always reflected, future speculation and valuation, but the forecasting has been getting pretty aggressive with over speculation and overconfidence, which has formed pockets of bubbles, especially in SPACs. Over half of the IPOs were SPACs, just like the 2000 dot-com bubble. I wasn't in the markets then, obviously, but people who were are seeing those similarities. 15 trillion got added into the markets last year. A lot probably being less experienced investors and stimulus money. And you could see that in Robinhood and other newer brokerages blowing up because they're creating an opportunity for that demographic. And that's comparable to the 1 to 4 trillion in other years, sometimes negative, where money exits the market from one year to the next. With YouTube, Reddit, Discord, and other new media platforms creating an environment for traders to access more real-time information, it's led to more pump and dump mentality. A lot of the SPACs have started to and are probably going to crash, and people will get burnt. Stocks don't just go up, unfortunately, and some of these companies will pull through and could be game-changing. The difference is 20 years ago, we didn't have any of the supporting data to properly assess value and sustainable growth of these tech companies. It was the idea and the dream at the time. Now we can see it, we can experience it, we know it's here and it's going to be around and progress from here. The markets just got a little carried away with speculation on some companies. The amount of option trading and people trading on margin is also pretty concerning. If things continue to fall, people are forced to sell off some of their positions and cover margin calls and other positions. They're risking more than they have to lose, and they're operating on debt. And it's adding to the sketchy behavior that we're seeing in the market over the last 12 months. So there's a lot of factors that are leading into what's happening right now, and upcoming, we're seeing instability and potential market crash conditions. We've seen a decline in stocks over the past 2 weeks that can continue. It's been a year since the stock market crashed, and some of the people who entered during that crash can now exit their positions and pay less in capital gains because they've exceeded 1 year of holding, making their investments long-term instead of short-term. And that anticipation of market falling and profit taking creates more investment and more investors sense that downward momentum and also exit, causing more of a drop, and that triggers automatic stop losses, which cause more of a sell-off, and then you can see how it can get pretty nasty. We've noticed institutional hedge funds diversifying their portfolios right now and selling overvalued tech stocks and SPACs and moving into more value plays as we run up over the last couple of months. With forward PE ratios much higher than normal levels, we see that divergence occur, and it's often followed by market crashes. There's a lot of greed in the markets. The media has kind of added fuel to the fire. Valuations are factoring in these amazing reopening with vaccines and COVID fears coming to an end. We have to consider yields and taxes potentially going up. Wealth tax, capital gains tax. Biden's in favor of raising corporate tax from 21 to 28%. This is undoubtedly going to affect a lot of companies' bottom lines. So what does it all this matter, and what does it mean for the future of the markets? I mean, in the long term, it kind of doesn't, but in the short term, it's contributing to the volatility and the confusion we're seeing right now. The government and the Fed, they have the best economists finding, ways to help the economy recover back to productivity and growth. Once things start pushing forward, the rest of the issues sort of will probably get pushed to the background again. Canada and US aren't the only countries experiencing COVID hardships. As the threat of the virus decreases, we start seeing pre-COVID levels, somewhere down the road, the Fed's just going to attempt to reduce that debt by raising interest rates, even though it probably won't have much of an impact on those levels. Or on the other side of things, you could say, we're going to see an entire economy meltdown, which would inevitably cause a collapse globally, a domino effect, in which case, you wouldn't want your wealth in some fiat paper currency that's no longer backed by the gold standard, that's just supported on the belief in the system anyway. You can't eat it, you can't live under it. But I think what we'll most likely see is smart money take advantage of these conditions. And in turn, that helps everyone because, you got your 401ks, your CPP. If big money loses, everyone loses. And it'll eventually take everything down with it. So I think after we see a reasonable correction in the markets, we'll see things slowly recover this year. And how they should have recovered in 2020. So either way you look at it, this year's either going to be an opportunity or a missed opportunity. So how do I position myself in a way to not get screwed? Time in the market is huge. So waiting on the sideline could hold you back more in the long run. If the can ends up getting kicked down the road again, picking up good companies with good management, this is a chance to get those discounted prices. If you miss the crash in 2020, you want to be cash ready, have good stock picks ready to go. Doing research now isn't even too late, but those windows of opportunity are starting to close and stocks will become less favorably priced. So I'm researching and preparing my list. I want to get some of these value stocks before they start to climb. And some of these really good tech companies, they're finally going to start coming down and entering discount territory. And these could be some life-changing purchases that can create wealth for years to come. You want to start that machine up, the dividend income, the market growth, and then reinvesting those dividends and compounding interest. I took advantage of that in 2006 when the markets were down, and also in the 2020 market crash in March. I bought literally right at the bottom, and that's when you want to get in, when everyone's all fearful and frantic in the markets. Obviously, things didn't feel right in 2020. The growth was artificial. So building a position at the start of a real recovery is the best time. We've had a lot of changes, an election, new policies, challenges in certain parts of the economy. So now we can kind of, get a better and a clearer idea of what we want to do. Or real estate. If housing starts to crash, it could be a good time to start looking into a good mortgage rate and scouting some deals, especially with the rise of crypto and CBDCs, the central banking digital currencies. No one knows how that's going to all play out in the next year. So I've started picking up some stocks on Friday. I'm going to slowly trickle in to the markets over March, and if they continue to tank, because you don't really know when it'll bottom out. The last crash bottomed in March 23rd, 2020. We could see more volatility leading up to that. And I'm kind of hoping for more red markets, even if it's, temporarily hurts my portfolio. Got to get them deals. So anyway, that's my plan. Share your thoughts below or in the Discord. Interested to see what you guys think about the whole situation. Hit the subscribe button if you're looking for more content, and do me a solid and like the video if you think it was helpful at all. Thanks, guys. I'll catch you in the next one.